Good evening, everyone. Welcome along. This is part of Ray White Metro. We like to bring information to our clients and certainly to add value to relevant information for you. And certainly tonight, protecting your assets is proving a very popular subject. So we have a good lineup of speakers tonight. There will be chance for questions and that. So look, without any further ado, I'd just like to first of all invite Lance from Kendons to kick off tonight's proceedings.
Hello everyone. Thank you, Tony, for the introduction and also giving me the opportunity to talk to you all. I'm Lance Edmonds. I'm one of the directors of Kendons. We are a chartered accountancy firm based in Christchurch, 4 partners and around 36 staff. We're a proactive chartered accounting firm. We do business advisory, but also traditional accounting, so like financial statements, tax returns, but we also dabble in the old advisory area, so business structures, cash flow, budgeting, helping finance applications, and a whole range of other advisory services. We mainly deal with small to medium-sized businesses and family-owned businesses, traditionally. So now I'm going to give an accountant's perspective on asset protection. Please note this topic is quite broad. We could spend the whole day talking about it, but I wanted to go over my experiences in this area and point out the key things we need to consider when it comes to asset protection. So from an accountant's perspective, we generally see business owners instead of salary and wage earners, as they tend to have very few, if any, risks. Therefore, we don't really talk to them about asset protection. However, there will be other reasons such for salary and wage earners like partner protection, potentially wills, but I'm sure the Harmons crew will have a bit of a talk about that. So, generally accountants, like I said, deal with businesses. We do sometimes deal with salary and wage earners if they have a rental property or dividends and shares. So my presentation is very much focused on business orientated people. We will interlink with the other speakers tonight, as we will need to work, as ultimately we should be working together to get the best solution for our clients. There's always compromises to be made. We all know about each other's profession. We need to be, and we also need to get the best outcome for our clients. But we obviously we will defer to the people whose specialty areas. But my personal view is that we all professionals need to work together and talk together, communicate together to ensure we get the best outcome. We don't want one particular professional going rogue on us. We all need to collectively work together. This is one of the main points I want to get across, is if all your professionals work together, and then overall you should have the best asset protection and also the mitigation of risks for yourselves. So, I'll be spending a lot of time around asset protection structures, as this is the first step as an accountant would look at. The 3 structures I'm going to talk about is individuals with insurance, companies and trusts. Then I'll go over tax planning versus protecting assets. This is where accountants and lawyers potentially have a conflict. We want to mitigate tax, but it also causes potential issues in regards to protecting your assets. So there's always a toing and froing between the lawyers and accountants. I'll then discuss about the gifting regime and creditor protection, and also a key thing from an accountant's perspective is document. We see this as all the time where people have a structure set up, but they've not done the correct documentation at the start, during it, and at the end. So it's quite important. And then I'll finish off my presentation talking about the Inland Revenue and their perspective and their views of asset protection. So, when a client first comes to me, I asked them what are their activities and how risky are their activities. I asked them what type of assets they have, like, for example, a family home, a rental property, do they own shares. I try to understand if we need to separate these personal assets from their risky activities, which is generally business activities. If there's an element of risk then in their activities, then in most cases I would use a company structure for them. And the biggest advantage of using a company is to limit their liability. In this case, only assets that are held in a company are at risk, and your personal assets would still be held in your own name or in a trust. That's separation. So I'm going to go through generally the different structures and the levels required for asset protection. All of these structures should have public liability and indemnity insurance, and also in some kind of income cover, like income protection, ACC cover plus extra. So you always, no matter what you have, you've also got to have insurance for whatever structure you have. So the first level, an individual has a low risk activity, no assets, and the business is making a wage. I would potentially leave them as a sole trader, an individual, and ensure they have insurance and income protection around that. The next level, if you have a low risk activity, however you own a house or some personal assets, and the business is still only making a wage, I would look at staying as a sole trader or look at a company option, a company structure, and both of them would still have insurance. But then I would also make them aware of that in some cases insurance won't cover particular situations. So if you're going to be a sole trader, there is some risk that your personal assets could be dragged into the mix. Third level, individuals has some risk. Their activities are risky. Okay, they have no assets but still making a wage. If there's risk, I always default to a company structure straight away. Okay, even though they might not have any assets, company, because there's risk. A lot of the time, clients will compromise and say, well, and my thought process is at some point you're going to build up assets, you might as well have a company structure straight away. But some people don't. So we kind of say to them, well, you can do it later on when you look to buy your first home or a rental property, then we may do the restructure. Level 4, there's an element of risk in your activities. You have personal assets and the activity only earns a wage. I'd say company structure, the shareholders to be the individuals, because you've got an asset now. So there's risk around trying to protect that. So putting a company, it limits that liability. Level 5, you're an individual, you have an element of risk, you have personal assets, and the activity earns more than a wage, so that you're actually making super profits in this situation. I would advise a company structure and the majority of a shareholding to be held by a trust and have a share each for tax planning purposes. Level 6, you're an individual, you have a risky activity, you have personal assets, you're earning more than just a wage, and you also have significant business assets. I would advise a company structure, shares to be held majority by the trust, individuals have one share each for tax planning, but I would set up another company or put the business assets in a company, asset holding company, or in your trust. So if, in a situation, the operating company fell over, your business assets don't get taken off you. So, companies. Companies are a separate legal entity. They generally have the rights and obligations of a natural person, limited liabilities, whereas company is responsible for business debts and obligations. So there's some separation here. However, limited liability advantages can be reduced when the owners provide personal guarantees to suppliers and banks generally. So we just need to be careful if you are signing personal guarantees. And within that company, so there's some 8 topics I wanted to talk about. Risks of your activities. So as discussed, if you've got risky activities, you'd put your business in a company structure. But if you've got multiple activities and they have different risk profiles, it would be pretty reckless to have different risk profiles in one company. And an example of that, if you've got rental properties and you've got a construction business, all within one company. Rental properties are low risk, passive, okay? But a construction business, it's high risk. So you're risking your passive investments being exposed to your risky activity. so you would separate them. I'd always look at what the risk profile of each activity is. As a director, you are responsible to operate your company solvently, and if not, you could be considered to be trading recklessly and personally be liable. So you've just got to manage your company and make sure that you're not incurring any losses to any third parties, because there's a risk of being attacked. Now, if you're a director and you're not really involved in business, you shouldn't be a director. You have to be actively involved. So sometimes we say to the husband or wife or partner that you're not really in the business, you shouldn't be a director. Don't be a director. If you are, be involved in the business. Talked about insurance before, public liability indemnity. Generally, it will cover most situations, but there are some examples where sometimes insurance doesn't kick in, or there's actual legislation where they cut through this. And an example I want to talk about is health and safety. Basically, you cannot get insurance for health and safety fines. You can get insurance for fighting the fight, but you don't get that covered. And also, they cut through the limited liability cover, and they focus on who was involved in that health and safety, like a director or a staff member. So just be mindful that sometimes insurance doesn't cover everything. And we've seen lots of examples. I could go on about it for a while. Personal guarantees. Like I said, limited liability advantage is reduced when the owners provide personal guarantees to the banks and suppliers in respect of the company obligations. If you, as a shareholder director, sign those personal guarantees, then you potentially can be chased down to yourself individually. Even though the company's fallen over, they say, well, hold on, you sold a personal guarantee, we're going to make you pay that outstanding debt. Now, you may have moved all your assets away into a trust or something like that, but the risk is that you're responsible for that debt and you potentially could be bankrupted. Now, being bankrupt, is not an ideal situation. You got that for life. So all I say to you is don't sign personal guarantees. But when reflecting, the bank's always going to do that, but if you can limit your exposure, please do. Shareholder current accounts for a company. Now, what is a shareholder current account? It's like a bank account for owners. You put money in, you take money out. Us accountants will allocate salaries to that account and dividends to that account. And in some situations, the companies can owe the owners a significant amount. And a lot of the situations, it's hard to actually get those funds out in the short term. So it's a potential asset that's sitting there, but you're not protected. And unfortunately, if the business was to fall over, the shareholders are at the bottom of the list. So the liquidator, employees, ID in some situations, you've got secured creditors, unsecured creditors, and you've got shareholders. So you're at the bottom. Now, if that account that's owed to you is significant, there is an asset protection mechanism where you can put a general security on that account and bring you up to the secured creditor position. So there's mechanisms there that you can do in protecting your assets. Now, buy-sell agreement, this is where companies put insurance to cover over the owners, so if one of the owners was to die, and then the company would receive the insurance funds to pay out the estate. Now, this potentially avoids a situation that you may have to sell your business to pay the other partner out, or put adverse pressure on your business to borrow and pay out the estate. So a lot of the time you have buy-sell agreements and insurance cover in that place. As mentioned before, we talked about asset holding companies. If you've got large business assets, separate them. It's worthwhile doing. Now, if your business has retained profits in the company and you have available excess cash, then we would always recommend you look to transfer those funds out of your company to a trust or to the shareholders. And how we do it, we do it by declaring dividends, okay, to shareholders, and then transfer those funds out. Now, we generally don't want to leave those funds there because you're sitting your funds, your wealth you'd be building up in a risky activity, you make a mistake, all that good work could be taken from you. So the trust is your ultimate asset protection mechanism. A trust has no legal definition. It's often referred as a living will, as it operates while you're alive. The term trust refers to legal relationships created by a person, a settlor, when assets have been placed under control of a trustee for the benefit of the beneficiaries. A trust deed is a legal document that documents various rules and requirements that a trust must follow in order to operate a trust. So, we believe that the primary advantage of establishing a trust is to protect assets which both you currently own and which are accumulated in the future. It takes a long time to build up the substantial asset base, whilst it only takes one small event for those assets to be diminished or lost entirely. We basically want your wealth to be flowing through into your trust. We would never recommend your risky activities to be held in that trust. Like I said, we'd put it into a company. We want the proceeds from that risky activity to be transferred into the trust. The trust should hold your passive assets, which are likely to hold or increase value. For example, family home, rental properties, shares, cash. These assets should be transferred to the trust, providing that there are no major costs making it unequal to do. I wouldn't put your car, your home contents, or anything like that, because they're going to go down in value. Anything that goes up or hold their value, put it into your trust. The gifting regime. So when we form that trust and when we transfer those assets to the trust, a settler and beneficiary advances are created. So you're thinking, I've moved my assets into the trust, I'm all good. Okay? But the personal assets are now held by the trust, but you still have an asset in your own name, which is a loan between you and your trust, where the trust owes you the purchase of those assets. So most people, to eliminate that loan is to gift. Back in 2010, the government abolished gifting. So what does that mean? It means that we can gift as much as we want. This gives us the added creditor protection, because what we're doing is you've got no assets because you've gifted that away to your trust. Now, the more the time you have between an event that occurs and you did your gifting, the better off you are, because there is general clawback provisions. So if you decided, I know I'm going to get sued for something, I've got no insurance, I'm going to put it into a trust and then gift it away. But you kind of knew that the event was going to happen, so they would claw that back and remove that gift. So time is in your favour. If it's been 2 years, 3 years when you did that gift, how did you know there was going to be an event that happened? So gifting is very, very important. But we generally have a conversation with a solicitor to discuss the pros and cons of the gift and decide if creditor protection is the most important risk to cover. Okay, so we have to talk to professionals and make sure that we're doing this in the correct manner. Tax planning versus protecting assets. Us accountants, our job is to mitigate tax. However, we could put your assets at risk. So it's, like I said, it's important for professionals not to work in isolation, but the accountants needs to make the solicitor aware of our tax planning ideas. To give you an example, we could allocate salaries to shareholders, declare and retain the profits in the company and benefit from 28% for the company and the marginal tax rates. This goes against what I just said about moving those excess funds to your trust via dividend. When we do this, we potentially trigger the top tax bracket. Trusts are taxed at 33% and individuals are taxed at 33% at the top tax bracket over 70k. We can, in theory, defer that top tax bracket by retaining those profits in the company and doing it later on. But what we're doing is we're leaving the wealth in your company, exposing to a mistake that you may happen in the future, and that'll taken off you. So we just have to be mindful of that. Another example is where we have the ability to allocate trust income to the beneficiaries and to benefit off the marginal tax rates. But all we've done is created another loan between the trust and beneficiaries, which we then have to potentially gift off, and then have to wait a few years to know that that gift is going to be, it can't be clawed back. So we can be clever, but we can also have issues in regards to protecting your ultimate assets. Documentation. Our job as accountants is to check that the financial statements we produce match with the solicitor has detailed in the trust deed and any major transactions that have occurred. If someone does not look right, then we need to get it sorted straight away. Loan docs in the trust or not in the trust, insurance in the trust, gifting's been done. Our job is to record everything the solicitor, the bank have done from a financial perspective, but we also see you probably once a year. So we're kind of in a situation where we can identify issues that we may look at protecting assets, and we talk to the solicitor, talk to the banks, talk to all that to try and make sure we are documenting it properly, because we don't want trusts to be attacked or individually, because we've set this all up. If we don't document properly, there's risks of being attacked. Inland revenue. Generally, they don't have a problem with asset protection. But from my experience, they believe they should be at the top of the pile. And in some cases, they've actually legislated to do that. POE and in some cases GST. What we're seeing at the moment is the Inland Revenue getting pretty annoyed with companies falling over, being liquidated and they're missing out. So they're asking lots and lots of questions around what is your trust doing? Do you have a trust? Where are your assets? Because they're trying to probe to see if they can angle in and try and recover through your other structures. If you do it properly, you should have no problems. But they are asking a lot more information and they've got a lot of information. So the main thing is make sure you document it properly. So I'm happy to ask any in the Q&A questions. If you want to talk to me face to face, I've got one of the other partners here, Grant Duffy, down here as well. So if you've got any questions, you can talk to both of us. Thank you.
Thank you, Lance. And Lance will be around after, so you can, if you've got a one-on-one question with him. Thanks. Hey, now I'd like to invite the team from Harmons, and we get the legal perspective on it all.
Yeah, we have brought the whole team. Hi everybody, my name's Amy Highland. I'm a Senior Associate at Harmons Lawyers. Just a brief introduction there, we are a full service law firm. We've got 10 partners and just under 60 people altogether in our team, and we're currently located in Papanui. The team here tonight is myself, Sue Golds and Nicola Thine, who are both registered legal executives, Colin Abernethy, one of our partners in our family law team, and our assistant Siobhan, who's in charge of the PowerPoint technology, so no pressure, Siobhan. Between us, we're going to give you a very brief overview of some ways of protecting your assets, which may raise some matters for you to think about. It goes without saying that you should discuss your specific asset protection requirements with your lawyer, preferably someone at Harmons. Given the time frame tonight and the fact that you're all probably trying to protect your assets for different reasons and from different people, we won't be able to cover everything or answer all of your individual questions, but just out the door on the table there we've got a sheet which you can put your contact details on and just write down what you're interested in if you want us to send you a little bit of information, or you'll have our business cards in your gift bags, so give us a call or an email. So firstly, Sue is going to discuss joint tenancies and tenancies in common. Nicola will discuss wills and enduring powers of attorney. I'll talk about trusts, although Lance has already given us a pretty good rundown there. And Colin will talk about relationship property considerations. Hopefully you heard all of that.
Hello everyone, my name is Sue Golds and I'm a registered legal executive and associate at Harmons. So just starting with a quote from Clarence Darrow, a leading member of the American Civil Liberties Union, who said that the trouble with law is lawyers. The law being a set of rules and guidelines which are enforced through social institutions governing behaviour and actions, with lawyers enforcing those actions and achieving the right outcome for clients based on their individual needs. So I'm going to talk briefly about joint ownership, where two or more people own a house, and the two ways in which names are recorded on the certificate of title to that property. When purchasing a property personally with another party, you can choose to own the property as joint tenants or as tenants in common. Deciding on which form of ownership to use depends entirely on your personal circumstances. The first of these is joint tenancy. Joint tenancies arise when two or more people buy a property together and their shares in the property are undivided and undefined. The significant feature of a joint tenancy is the right of survivorship. When one of the joint tenants dies, their share of the property transfers automatically to the surviving joint party. The interest held in the property is not capable of passing under a will, or where there is no will under an intestacy. Joint tenancy is most commonly seen in purchases by married couples or couples in a long-term relationship who intend owning the property equally and passing their share to the survivor in the event of death. A joint tenancy may not be the best method of joint ownership, For example, if a de facto couple hold property as joint tenants and they have put in unequal shares in the house purchase, and one of them dies, their share will automatically pass to the survivor instead of to that person's family, regardless of any instructions to the contrary in the will. This also occurs if there's a second marriage, where there may be children from a former relationship. Another scenario is where one party dies and the survivor then has the property transferred to his or her sole name. If that person then has to enter retirement care, the value of his or her assets will be assessed to determine if a rest home subsidy is available. This is an example of how a joint tenancy will be recorded on a certificate of title. The alternative is holding a property in joint names as tenants in common. Tenants in common allows for owners to hold a distinct share of the property. There is no requirement that a tenancy in common must result in equal shares of ownership. One major advantage of owning property as tenants in common is that the owners are able to dispose of their share in the property in accordance with the terms of their will. If a person does not have a will, then their share will be distributed in accordance with the intestacy rules set out in the Administration Act. But you need to be careful, as the Act states that the first person to inherit is a spouse, so he or she might end up having the property transferred to him or her, as in the case of a joint tenancy. It is therefore vitally important that, as a tenancy in common scenario, the owners have a valid will, which clearly states out how their share of the property is to be dealt with after death. Often this type of ownership is favoured where there are children from a former relationship, and there is the opportunity to protect a proportion of the assets for those children. On a person's death, his or her share of the property will not pass to the survivor, but in accordance with the terms of a will. There may be a life interest granted to the survivor until certain specified events occur, giving that person the right to income from the half share, and on that second person's death, the assets will be realised and beneficiaries will be paid from the protected share. Wills are a major part of a tenancy in common situation, which Nicola will go into more detail shortly. For couples wanting to buy a property together, it is important to consider the effect of each type of ownership and that the effect will have on them. And that's an example of how a tenancy in common is recorded on the certificate of title. Relationship, property and family protection implications are significant, and Colin will go into more detail on these aspects shortly. So just to end, it is possible to convert a joint tenancy into a tenancy in common. This may be opportune in the event of impending bankruptcy by one owner of the property or a breakdown of a relationship. It should be noted that there are very strong anti-avoidance provisions in the Social Security Act, and any disposition of property which is viewed by the Ministry of Social Development as being one which was designed to transfer ownership of an asset that would otherwise have been available to pay for your care can be overturned. So now it's over to Nicola to discuss wills and powers of attorney.
Hello, my name's Nicola Thine and I'm a registered legal exec at Harmons. A will is obviously a very important document that states your wishes and disposes of your property on your death. It only comes into effect when a person dies. The will maker appoints a person or persons to administer their estate, called the executors and trustees, and record their wishes as to what they want to happen to their estate. There is no one-size-fits-all for wills, and a will is required to reflect the ownership structure of assets owned and depends on such matters as family trusts, company ownership, and tenants in common. If property is owned as tenants in common, as discussed by Sue, then reciprocal life interest wills are usually prepared so that each party has a life interest in the other owner's share. This step can be used for estate planning purposes, as it reduces the ownership of each party to their individual half share, rather than the full value being left by survivorship if it's owned jointly. By owning a property as tenants in common, this can assist with reducing the asset threshold as far as residential care subsidies go. However, this may differ if, for example, two or more friends owned a property rather than a couple, and they wish their share in the property to be left to their own family and friends. And in this case, it is usually recommended that a property sharing agreement is entered into at the time the property is purchased, which would outline what they want to happen to that property should one of the owners die, or maintenance, loan repayments and that type of thing. Accordingly, the timing and intent of any transfer of property and execution of the life interest wills is therefore an important factor. However, subject to these cautionary words, tenancy in common and life interest wills are legitimate and commonly utilised estate planning tools. This differs from the joint assets that pass automatically to a survivor on the death of the first party, and as well as property, the rule of survivorship also applies to joint assets such as bank accounts, vehicles, and the like. This links back to the information that Sue provided. And just briefly about powers of attorney. There are two different types. There's an ordinary and enduring. So ordinary is an authority given by one person to another to act on their behalf. It's valid until it expires or is cancelled, but an ordinary power of attorney can't be used once that donor, the person who made the document, loses capacity. So that's where the enduring powers of attorney differ, because that endures whether someone's got mental capacity or not. There are two types of power of attorney. You've got your property, which is obviously physical property, but also bank accounts, utilities and the like, and personal care and welfare. So a property appointment can come into effect immediately, which means your attorney could act on your behalf if you were just in hospital or overseas, but a personal care and welfare only comes into effect once a donor loses capacity, so no one else can make a decision on your behalf while you've got that capacity, and that's usually assessed by a specialist in hospital assessment. Because the power of attorney, because of the power being given to the attorney, careful consideration should be given to who you appoint as your attorney or attorneys. If someone loses capacity, mental capacity, and has not signed a EPA and a third party is required to act on their behalf, for example, sell a property, an application is required to be made to the family court for a property manager, and this can be quite a costly process. An EPA is a bit like insurance, important, but you hope you never need to use it. There are a number of options within the power of attorney documents which the donor can stipulate, such as joint appointments, successor attorneys, consultation with others and providing information, any restrictions they might want to put on that power. An attorney's appointment can be revoked at any time, so long as the donor has capacity. So if they're deemed to have lost capacity, then whoever they've appointed at the time, that appointment stands. So it's really just a very brief overview on those different options. So now Amy's going to have a word.
As I said before, I'm just going to briefly talk about trusts, following on from what Lance has already covered. So trusts are a very common suggestion for asset protection, but it's certainly not a magic solution. The law surrounding trusts is very complicated and it's constantly changing due to court decisions. The Trustee Act, which has been around since 1956, is currently in the process of reform, with the recent introduction of the Trust Bill to Parliament. The idea of this is to make trust law more accessible, to clarify and simplify core trust principles and essential obligations for trustees, and preserve the flexibility of the common law to allow trust law to continue to evolve through the courts. So we'll see if that does indeed help matters. The courts can look through trusts for various reasons, but if used properly and often in conjunction with other means of asset protection, they can be useful. So as Lance covered, a trust is not a separate legal entity itself, like for example a company. A trust is a relationship between the settlors, who are the people who create the trust and put property into it, the trustees, who hold the trust assets in their names and deal with them as required by the trust deed, and the beneficiaries, who receive the benefits from the trust. Generally for a straightforward family trust, which is set up to own your family home, you and your partner, if applicable, will be the settlors, as well as trustees and beneficiaries. There will usually be other beneficiaries, which might include your children, grandchildren, and anyone else you want to provide for. It is recommended to have an independent trustee to assist with the management of the trust and help avoid the temptation for you to continue to treat the asset as if it were your own. So some of the potential reasons you might consider setting up a trust include for creditor protection. especially for business owners and directors of companies and things like that. Lance covered a lot of that, so I won't repeat it. But I'll just reiterate what he said in terms of the timing of setting up the trust and transferring the assets to it. The sooner the better. If you're transferring assets to with the intention of defeating a claim from a known or existing creditor, that's likely to be overturned. So if you already know someone's after you for money, don't just try and set up a trust and put your assets into it. And this is a situation where you're most likely going to need accounting advice as well as legal advice. Providing for your children. So this might be relevant especially if you have children with special needs, or if you have concerns about their ability to manage their financial affairs after your death. You can leave your assets to your trust with instructions to the continuing trustees to provide income and, if necessary, capital to the children so that they can be looked after, but they can't sort of fritter away all of the money. Maximising your eligibility for income or asset-tested benefits used to be a very popular reason for setting up a family trust. So individuals or couples would set up a trust, transfer their family home to it, and gift the value of the property to the trust over time, with the idea that once the property was entirely gifted into the trust, that asset would be excluded from their personal assets when being assessed for a residential care subsidy. We wouldn't generally recommend setting up a trust nowadays specifically for this purpose. We're not sure that residential care subsidies will be around for too much longer, and even though, as Lance alluded to, there's no longer a gift duty and you can gift a property into a trust all in one go, there are limits on gifting when applying for a rest home subsidy. So that limit is currently $27,000 per year, and that's not per person, that's per couple. So it takes a long time to gift the value of a house at $27,000 a year. And also, as previously mentioned by Sue, the Social Security Act contains the anti-avoidance provisions. So you can't try and get out of paying for your own care just by transferring assets out of your name. Relationship property considerations are also a good reason for people to set up a trust. But keep in mind that if you're wanting to use a trust to protect your assets from a spouse or a partner, again, the timing of forming the trust and transferring the assets to it is important, as is the ongoing management of the trust. As Lance said, document, document, document. If you are setting up a trust for relationship property purposes, your lawyer will talk to you about whether a trust is appropriate, or whether you need a contracting out agreement instead of or as well as a trust. If you already have a trust set up and you're entering into a relationship, you should also still talk to your lawyer about whether that existing trust offers you sufficient protection, or if you still need a contracting out agreement. Colin will talk to you more about that shortly, so I don't want to steal his thunder. I'll leave it at that. So when you're deciding whether to put your assets into a trust or not, there are some potential disadvantages to consider, and a few of those include loss of control. So many people don't understand that once you've put your assets into a trust, you no longer own them personally. You can't continue to control them as if they were your personal assets. Ownership is passed to the trustees, and the trustees must act in accordance with the trust deed and in the best interests of the beneficiaries. So if you're a settlor and a trustee of your own trust and you just tick along and treat the property as if it was your own, the trust could certainly be open to challenges as a sham or an alter ego trust. So once again, documentation and proper management of your trust is essential. The costs of setting up and administering a family trust can be significant. So you need to get good advice. You need continued advice, especially where your trust owns more than just your family home. It may involve accounting advice as well. Another consideration is the requirement to provide certain information to beneficiaries, and the requirements are getting more involved under the trust bill. There's going to be a lot of information that beneficiaries can request at any time, and so you might not necessarily want your children, your grandchildren, whoever your other beneficiaries might be, knowing all of your financial information. So it's a good idea to check who your beneficiaries of your trust are and limit those if necessary. So in conclusion, trusts cannot be used to avoid current and legitimate claims by business creditors or relationship partners. You need to get proper advice from lawyers and potentially your accountant. And now Colin's going to talk to us further about relationship property.
Thanks, Amy. I guess the beauty about speaking last in our wee group is that you have stolen my thunder, and I think I've got like a minute left or something, so I'll smash through it. I'm the token family lawyer for the evening, and the bulk of my practice centres around relationship property considerations. And I guess what I do is I try and find relationship property and then divide it when couples separate. But not only that, try to protect it and protect separate property from becoming relationship property. And basically my big message for this evening is do a contracting out agreement every single time. If you're thinking about, if you have an asset and you don't necessarily want your partner to end up with half or some of it, then do a contracting out agreement, and they sit very nicely alongside trusts and companies and bits and pieces like that. I've put sleeping with the enemy up there, and that's, I guess, my tongue-in-cheek way of saying, who are we protecting the assets from? And we're talking about future partners or current partners, or maybe preserving assets for a child from a prior relationship. So I'm going to cut out a few little bits and pieces. If we look at some of the straightforward stuff, your family home, regardless of the ownership structure that you've chosen, if you've set it up as tenants in common and you own 80% and your partner might own 20% to reflect unequal contributions, doesn't matter. If you're in a qualifying relationship, 50-50 all day long, and same with your family chattels. You might have owned the house before you got together. You might have used money that you saved before you got into a relationship. If you don't do a contracting out agreement, the starting position will be that your partner gets half. And if we look at some of the more complicated stuff, well, all right, I've gone along to see my lawyer Amy at Harmons. I've worked hard, I've managed to set up my own business, and Amy says to me, look, Colin, owning your business has got a lot of risk, and so you really should transfer your assets to a trust. So I think, cool, all right. I'll chuck my rental property into the trust, but the rent's not what it used to be, and so unfortunately it's not covering all of the outgoings. It's covering my mortgage repayments, but I'm having to pay my rates and insurance myself. The shower leaked through the top ceiling and dripped down onto the next level, so I had to pay for the plumber. And all of that, those contributions mean that you need a contracting out agreement because it all links from your income. Your income, if you're in a qualifying relationship, so you're longer than 3 years, it's a general rule of thumb, then your partner is entitled to half of your income earned during your relationship. And so if I've put my rental property in the trust, but my partner's not a beneficiary of that trust because I set it up before she came along, I'm taking a portion of my income, which she's entitled to some of, and putting it beyond her reach in that trust, something that she won't benefit from, and so a claim will follow through there. So have a think about the structures that we're setting up. What's happening with your income? Some of it will be going into your KiwiSaver. That's increased in value during your relationship property claim. Paying off some separate debt that you've brought into the relationship, well, your partner's not getting any benefit of paying off that debt because you incurred it beforehand, so there's a claim there. Maybe it's a student loan and it's taken out automatically from your pay. You need to think about all of that stuff. What about your batch in the Marlborough Sounds? Well, I purchased that before the relationship. My family has used it, so there's no way that can be brought in. Well, not necessarily, because what's happening with your income? Are you paying the expenses, the rates, the insurance with it? Maybe yes, it increases in value, half of the increase in value. So there's all of that sort of stuff where, look, I think you really need to have a think about a contracting out agreement, or at least having that discussion. Maybe you're self-employed and you've been working with your accountant at Kendon's to set up your company structure and your business. But I think, like Lance talked about, you've got a current account with that business. And maybe your company doesn't have the cash necessarily to pay you all of the salary that you're entitled to. So rather than actually getting cash in the hand, your current account balance increases. Well, I will be very interested in that as a divorce lawyer, because they'll say, well, have a look there. There's a whole lot of income sitting in that current account, so we'll take half of that too, please. The court takes a really hard line in relation to this stuff. And the reason for that is that the New Zealand Family Court is required to recognise monetary and non-monetary contributions, and they treat them as equal. So it's not just about the money, it's also about performing household duties and tasks and bits and pieces. And that's why we have these default provisions in terms of equal sharing right from the get-go. What about the 50K that Grandma left me when she passed away? Well, ultimately, I want my children to get that when I pass away, but we may as well use it. We may as well chuck it down on the mortgage so that we've got lower repayments and the whole family can benefit. Well, you do that and you don't do a contracting out agreement, well, then you're going to lose half of it if your relationship ends. It's all about retaining control. Controlling what happens to your own assets as much as possible. Please don't leave it up to a judge to make a call because you don't know who you get on the day. I'm aware of one case in particular where the couple had 2 chihuahuas. And at the end, rather than getting one each, which you think would be logical, the judge decided that he's going to give both of the dogs to one party as he felt that it wasn't in the dog's best interest to separate them. My wife brought our wee Westie, Lola, into our relationship, but if we split and she moved to a property that wasn't fully fenced, then a judge might decide that it was in Lola's best interest to stay with me because I've got the property with the fence around it, although I would be taking my life into my own hands at that point. But so the message here, look, put your dogs into your contracting out agreements. Anything of sentimental value, pop it in there because it is not worth having the fight. Lawyers are expensive wee beasties, so don't give them grey areas to fight over. Right. The other message I guess I wanted to give is that if people who have spent most of their adult lives overseas somewhere, they are particularly vulnerable to our relationship property laws because some countries have the complete reverse situation where you actually need to enter into an agreement to opt into sharing your assets. So they're very vulnerable in those circumstances, and I guess it's just be aware that just because you own something before you got into your relationship, it doesn't necessarily mean, in fact it likely won't mean, that you get to keep it as separate depending on what you do with it. Contracting out agreements is also a great way of setting the expectations right at the start of your relationship. You might have a pre-relationship house that's in your trust, but of course your KiwiSaver, your bank accounts, your vehicles, your chattels, all your personally owned stuff is still exposed. And people still tend to refer to their home as my house, notwithstanding it's actually owned by a trust. So your new partner might come along, no idea about the trust structure. They've been making contributions, mowing the lawns, painting a bedroom, fixing the leak in the roof. And of course, maybe their income is being used to repay mortgages and perhaps upgrade the property. The court's got the ability to recognise all of those contributions, notwithstanding the house is owned by a trust. Don't leave it to chance. But if you do an agreement at the start that's going to spell out loud and clear, the house is owned by a trust, all of your contributions is just in lieu of rent. You're getting to live here for nothing, so suck it up. Right. The final few comments. It's super, super easy for someone like me to sit here and advise someone that they should be entering into a relationship property agreement, but the difficulty is that they are not romantic documents. I really do love you, hun, but please sign this. It's also a very strict process in terms of the rules that you must follow in order to have a compliant document. Both parties have to get their own lawyers, and those lawyers have to be from different law firms. You need proper independent legal advice in relation to the effect and implications of this agreement. And that not only involves understanding what the contract says, but you kind of also need to know what a judge might give you if you don't do one so that you can compare the two. And if you don't follow those rules, and if people write up the documents themselves and sign it, it's void. It's not worth the paper it's written on. There are certainly ways that people can limit the damage and minimise property that might be available to future relationship claims. You work with your accountants and bits and pieces, but look, when that new relationship comes along and you're blinded by the love and the passion, the best way to protect your assets from a claim is to do a contracting out agreement. Our family law team at Harmons can help with all separations, care of children disputes, adoptions, surrogacy, domestic violence, relationship property matters, including the agreements that I've discussed. So thank you very much to Ray White Metro for inviting us along this evening, and thank you all for your time. Cheers.
Thank you, Harman team, and of course they will be available after if you've got some questions. Hey, look, now I'd like to introduce from our Metro Loan Market team, we have both Simon and followed by Chris. We'll cover mortgages and insurance.
Good evening. Simon Moore, mortgage broker at Loan Market Metro. I'll be speaking about the banking scene and some aspects of the lending market. I guess typically if you're looking to protect your assets from a banking perspective, you're looking to protect your cash, so your term deposit or making sure you're in the correct KiwiSaver scheme. I can't give investment advice. I'm not an investment advisor, unfortunately. So those that lost money in finance company failures and what have you would know that it's very important to understand what you're investing in, but I can't advise on that. What I am going to touch on is just the banking scene, what's happening at the moment, what's happening with interest rates, and just some ideas about if you are borrowing money, some popular structures to maybe protect yourself from fluctuations in the interest rate market. So banking scene, what we've seen in the last 12 to 18 months is credit policy tightening across the banks, and that's been largely imposed by the Reserve Bank due to concerns of if we are in fact in an overheated market, particularly places like Auckland and Queenstown, and if there was a correction in values, whether that would expose our banks to risk in terms of their stability. So the Reserve Bank restrictions that have been hitting our banks is not so much about trying to cool the property prices, but it's actually trying to eliminate the amount of money or the percentage of money against the value of that property each bank is lending to deleverage those banks from risk if there was a correction in the market. So what we've seen, some changes, investors are generally now required to put in 40% equity or deposit to an investment property. There is one exception to that with new build constructions that's exempt from the Reserve Bank rules. Getting a home loan with less than 20% deposit is now challenging. So if you own just a home and you want to buy a property, if you've got less than 20%, then most banks are allowing first home buyers to access those funds. The banks can only lend 10% of all their loans to low deposit borrowers. So it's a very small bucket of money, and they're cherry picking who gets it, and in sort of, I guess working in with the spirit of the Reserve Bank restrictions, they're trying to give it to first home buyers. We've also seen buyers without New Zealand residency or they generate their income offshore, having some restrictions placed on them. And I guess in terms of the general banking scene, some of the changes we're seeing, which are a little bit subjective, but the relationship management's probably not like what we'd say in the old days. So staff turnover is very high in the banks. You get assigned a personal banker. 12 months later, they've moved on to a different department. You don't know who your banker is anymore. You don't know who to ring. You go to a call centre. So that relationship management aspect of banks has changed over the last few years. We've seen branches closing or merging. And in fact, they're starting to see a few branches now that are fully automated without anyone actually in them. And you can do everything on a touch screen or a voice to a person somewhere else in the country. So, you know, from our perspective and my business as a mortgage advisor and insurance advisor for Chris, it's actually about relationship. That's the most important aspect of what we believe. We want to give you that higher level of service than you might find if you were to walk into a branch. Interest rates, let's move on to that. I grabbed these rates a few days ago, and I've only selected them from a few banks, not every bank, and those were the best rates available online. 1 year at 4.45 and so on through to the 5 years at 5.59. In recent weeks, the discounting that we've been achieving is on the right. Everyone's situation is different, but you know the advertised rates are not necessarily what you should be paying, and there is some discounting out there for that depending on the strength of your application and the purpose of why you're borrowing. With those discounted interest rates, what you'll find is the banks would expect you to have a main banking relationship with them, so that's typically your salary credited to their bank account, and probably a supplementary product of some sort like a credit card, KiwiSaver, or something in that vein. most banks are now having two-tiered pricing. Not all, but some certainly are. So the best interest rates, some of those rates we just saw before, are for owner-occupied properties with 20% deposit. If you're an owner-occupied buyer with less than 20% deposit, those rates won't apply to you, typically. So we'll see higher rates and fees for borrowers with less than 20%. For an example, some banks, if you've got a 10% deposit, will charge you 6.04 for that 2-year rate. And we saw up there that, we can get as low as sort of, 4.3s. So it's quite a big jump if you don't have that deposit. And we're seeing higher interest rates being offered by some banks if you've got a standalone investment property with them. So you might have your owner-occupied property at one bank and your rental property at another. Some banks are now increasing the interest rates because they're only holding a rental property, and for them that seems to be deemed as higher risk, so they charge a slightly higher interest rate. Not all banks are doing that, but some are. And those rates, those margins we're seeing on top of the interest rates are sort of 0.2 to 0.35 higher. That's the graph of interest rates since year 2000. So we sort of saw interest rates hovering about 6.5% back in 2002, and then the trend line was gradual and steady and upwards to the point, to here, to the point where interest rates were hitting nearly 11. And anyone that owned a home back here and then ended up owning one there, they probably doubled in price, which was great. So most people saw all this capital gain occurring, and yay, this is awesome. Not worried about paying a higher interest rate because my house has almost doubled in value. But then we had the GFC, the global financial crisis. New Zealand was relatively largely insulated from the shock compared to a lot of other countries around the world, with property prices maybe peaking back 10% or so, maybe a little bit more in certain areas. But interest rates dropped really quickly compared to that long climb, and they fell back down to sort of that figure that we started on back here in 2009. And we've seen a very stable rate environment since then, with rates declining for the last 2 years to historic lows at about Christmas last year, the lowest since World War II, so about 70 years since we've seen those interest rates at that level, and a slight climb this year as the US Fed Reserve put up its interest rates and the cost of funding for the banks has increased, so they're passing that on to their borrowers. That little trend line upwards, and it's plateauing at the moment. If you read any economic reports at the start of the year from the likes of the BNZ economist Tony Alexander or Cameron Baggery from ANZ, those guys were saying, hey, look, we think interest rates will probably climb throughout 2017 and probably into 2018 because of the cost of funding offshores increasing, and to attract local depositors to put money in the bank, we've got to put up term deposit interest rates. So for both reasons, interest rates will probably rise. So there was a bit of caution about, hey, lock in now for a couple of 3 years. What we've seen is those expectations of rate rises offshore haven't really happened as fast and as aggressive, and we're seeing that plateauing effect again. So, the thing with interest rate predictions is it's a pretty fraught game, and you only need to read someone like Tony Alexander, who puts out a commentary every week on a Friday, and he will put his hand up and say they probably get it wrong about 75% of the time in terms of trying to predict what rates are likely to do. And the reasons for that is they have a set of incoming data that they try and predict what rates will do, and then something around the world will change, and that'll change where rates go. So, what happens if the US and Korea go to war, or what happens if there's some trade issues with China or someone else? What does that mean to our interest rates? Well, until that happens, they can't really predict that. Interest rate structure. What's the best way to set your loan up? And there's really, again, touching on some of the other advice tonight, there's really no one size fits all because everyone's circumstances and goals are different. But here's just some common thoughts. Do you take the lowest rate on offer and versus, say, 1 year versus 2 years at a 0.34 difference? Are you better to roll that year on year than take the 2 year certainty now? So it's that speculation versus certainty debate. And you'll never get it right. You'll always look back in retrospect and go, oh, maybe I could have done it better, but we don't have a crystal ball. Another option for structuring your loan, rather than having it all on 1 year or 2 years, for example, would be maybe to split your loan up into 2 or 3 portions and just hedge your bets a little. The smaller portions of your lending are exposed to different interest rate environments, thus removing risk of the whole bucket of lending being exposed to a different environment in the future that we don't know what it's going to look like just yet. And I always say to clients, look, some of the considerations for structuring your loan come down to you individually, such as what your personal plans are. There's no point fixing for 5 years if you think you might sell in 3, because you might be exposed to large break fees. You might be having a large windfall of cash coming, you know it's due in a year's time. Well, don't fix for 3 years if you think you want to make a lump sum in a year's time, because you probably have some restrictions and some extra penalty costs. Obviously, there's the certainty debate, how long you want certainty for on your rates. And then, of course, taking into account the sentiment of what's likely to happen in the interest rate market. And we sort of looked at that graph before, how it hasn't quite gone up as high as was expected. You can sort of take some of those things into account when you look at your mortgage options. I think the key point to remember is individual circumstances, tolerance of uncertainty, and your future plans all need to be taken into account when making decisions on rates and what's suitable to you. In terms of risk, which was tonight, sort of protecting your risk or protecting your assets, and a lot of that stuff I've talked about isn't necessarily directly relevant to that. But, you know, some of them are, you know, deleveraging your debt, you know, getting your debt down so you're not exposed to some of those interest rate environments. And, you know, getting your loan down is certainly a good idea. Most banks allow extra payments while you're even on a fixed loan. So some people think, I'm on a fixed mortgage, I can't make extra payments. Most banks actually do allow you to do that. A common rule with a number of the banks is 5% of the balance in either lump sum payments or increased weekly payments in a 12-month period. So you can make additional payments whilst you're fixed in a 12-month period of up to 5%, either one lump sum or spread it across the 52 weeks of your weekly payments. You could also maybe have someone floating or revolving credit. So if you've got sort of lumpier cash flows, you could throw some money into those products, and there's no restrictions as to frequency or amounts. Not sure how clear they are to read from your end, but just a couple of very simple debt reduction examples. You don't need lots of big pie charts, spreadsheets and graphs to try and, it's a very simple thing. The more you put onto your home loan, the quicker you'll pay it off, the more interest you'll save. It's really as simple as that. This example here, someone's got $350,000 on a 28 years to go on the term. So 350, 28 years to run at 4.75. Their standard payments are $434 a week, and they're paying an extra $100 per week. That saves them $99,000, and they'll pay off their loan 9 years earlier. So quite powerful. Just need to focus on paying more than the minimum. The last slide is simply someone maybe who's had a reduction in interest rate. So they were maybe paying 5.95, they're now paying 4.75 because their interest rate's come off its fixed and they've refixed at a lower rate. If they want to keep their repayments the same as they were prior at the higher rate, they will then in this case, they will save $69,000 worth of interest, and that's an extra $59 per week in repayment. So they're paying above the minimum on that lower rate. So those examples obviously have a fair degree of assumption, which is those interest rates will remain for the 28-year term and the person will continue to pay those extra payments for the 28-year term. That's obviously not likely to happen, but in simple terms it shows the more you put into your mortgage, the quicker you'll be debt-free, take away that risk and achieve some financial freedom, I guess. So that's all I've got. I'll pass on to Chris because I know time is going pretty fast. Thank you.
Right, insurance, huh? The last topic for the evening. That's really exciting. I think tonight's really highlighted to me the importance of having really good advisors around you when you're in business or when you've got an investment property or whatever the case may be. We're all really passionate about what we do, and I think that's why we tend to go on a lot longer than we should. But in most cases, what we're really doing, whether you're seeing a lawyer, an accountant, a mortgage advisor, or a risk advisor, is we're doing risk management. That's in an essence what we're doing, and we're going to put a contingency plan in place for you. So what is risk management? Life is full of risk. Could be paying too much tax, could be getting divorced, could be having the wrong company structure, falling ill, dying too early. There's so many risks in life. And as a risk advisor, basically what we want to try and do is minimize that risk. We're never going to take it away. There's always going to be some risk in your lives, but we're going to try and minimize that by having a correct plan, a proper plan in place that everybody understands. So when something does go wrong, you know exactly what the process is going to be going forward. This is a financial planning pyramid from my past. It's just taken straight off the internet, so there's no playing games and changing things around. But basically, I think all of us that have spoken tonight, we've all worked from the bottom of the pyramid up. The most important thing is having a plan in place. As I said, it's really important that you know what's going to happen if something does happen. We've spoken a bit about wills. I'm going to talk very briefly about insurance because it's not that exciting. And then setting up trusts, debt reduction in the green part there. So it's all, if you've got the basics, you've got the foundation of your plan right, it makes things a lot easier going forward. So we'll jump onto the insurance part now. And this is going to take a bit of audience participation. We love statistics and insurance, so just bear with me. The first thing is, how many people here have had a car stolen and not recovered? If you can just, quick show of hands. Yeah, clearly we're not in South Africa, because it would be a lot worse. Okay, so one of us. So statistically, 1 in 700 people will have a car stolen and never recovered. Yet we all insure our cars, hopefully. The next one is, how many people have had a house or know somebody who have had a house that's burnt down? Okay. Yeah, a few more. 3 in 100. Now, this is an American stat, so it's probably, I'd assume it's a little bit worse here, just the nature of our buildings. Now, the good part. How many people know somebody who's passed away before the age of 65? Yeah, it's pretty scary, isn't it? 1 in 7 people will not get to the age of 65 because of death. And the last one, just to really G you up, how many people know somebody who has suffered from cancer before the age of 65? Yeah. 1 in 3 males and 1 in 4 females will suffer from cancer before the age of 65. So life insurance is obviously something that can address these issues, but it's not the one and only answer. You may have a property that you want to sell. There's 1,000 different ways to address these issues. But the important thing is that everybody knows what your plan is if something does happen. Yeah, I mean, that's basically me. I think we saw tonight exactly the importance of having something in place if you do fall ill. Yeah, that's me. Short and sweet, yeah.
Thanks, Chris. Well, look, our speakers will be available if you've got those burning questions you would like to bring up with them. And look, I would just like to thank you all for coming out on another winter's evening, and hope you've gained something from our information evenings that Ray White Metro are providing to you, our clients. I just say thank you.